Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
Good morning, everyone. Welcome back to another episode of, excuse me, the AJ Brown Show. My name is Cyprian Francis, and with me, as always, main man of the summer, of the year, of the last 20 years, Mr. AJ Brown. Good morning, AJ.
Hey, Cyprian, how you doing?
It's summer, right? It's summer out here in California, where we're just getting over the June gloom, feeling the positivity in the air. Although this morning I feel like we're starting to get some economic news. Some of these Fed people are out talking about how we're going to continue to raise rates. What should I be making of the chatter in the news today?
Well, I'm going to jump right to technicals because it's doing exactly like we said, Sip. We talked about last week how it was getting a little bit too hot to sustain, and that I would have liked to see this start to pull back somewhere between this 4,230 mark and this 4,307 mark, 310 mark, somewhere between there. And so it did confirm for us just last night, and it looks like that confirmation is going to hold. And what that confirmation told us was that, let's see, back on June 15th, we hit our highest close, and now we're going to take a little bit of a break and contract a little bit. We haven't in this whole uptrend seen any sort of ideal movements. They've all been sort of extreme. So it would be nice to kind of get, if this uptrend is to continue, get an ideal pullback. Again, I keep pointing out this 4,230 to 4,310, somewhere in between those two numbers. If we can pull back to that level, and that'll give us a good foothold to shoot higher. So I'm not at all concerned with these discussions. I mean, Jerome Powell had some testimony that he gave to Congress. I believe it was Tuesday and Wednesday. And then, like you said, all the other Fed chiefs are out there, and they're reiterating that if they're going to need to, they're going to go ahead and continue to raise rates. And I'm okay with that. And I'm also okay with them taking this break to allow some of the things that they have done already, the tactics they've already taken, to kind of settle in.
And so, if they're sitting on the sidelines, what are we looking for in order for them to move one way or another? Right, we're starting to get some employment that's starting to slow down a little bit. I think we're getting some manufacturing that's starting to slow down. I mean, a little bit of a slowdown helps the case for no increases, right?
Yeah. I mean, that's what they want to see. They want to see the economy moderate. It's still a little bit too hot. In fact, I'm looking just really quickly here at what investors think is going to happen. So the next meeting is going to be July 26th. So the end of July. And investors are already banking on the fact that they believe that there's going to be another quarter point rate hike. When you look at the economic news, I mean, at least the economic news from this week, we didn't have much news. We had our housing starts and permits. Our housing starts and permits came in much hotter than expected, which is not bad because housing has been one of those areas where prices have been staying higher. And the reason why prices have been staying higher is because we haven't really built many new houses to accommodate our growing population. And so there's been a supply crunch. So seeing housing starts and permits come in hotter than we expected, this is not a bad thing for the future. It means that housing prices may moderate and become affordable for the new generations coming out. We also had our existing home sales. Let's take a look at that really quick. Click on that. If we take a look at our existing home sales, you can see that they came in right as expected. They did expect perhaps um, a little bit of a drop month to month, and instead they held steady. You can see that existing home sales have dropped year over year. Things have kind of cooled off. In fact, I talked to some mortgage broker friends of mine, and my mortgage broker friends are saying that they're having a hard time finding work. A lot of them work on commission, and so a lot of them are trying to make ends meet right now, or they had to, squirrel during the hot periods a couple of years ago, and so now they're living off of that savings that they had. But yeah, this is all good news for the Fed, but the Fed is keeping their options open for sure. One other thing that I noticed about the Fed, you know how they like to sell back the bonds that they have been accumulating over the years. And if I come back and I'm going to hit refresh on this kind of report that they publish, see if we can't get some more recent numbers. They've been publishing these numbers as we've been setting up. You can see here that the Fed has sort of moderated when it comes to selling their bonds. In fact, if I go back 6 months, you can see that little spike that occurred in buying bonds because of the regional banks starting to fail. And then they've been slowly selling off again, but they're kind of stalling at that level that they had achieved. Now, that level, if I go back a couple years, even further, let's see if we can stretch this even further. You can see that that level is like nothing compared to the bonds that they bought ahead of the pandemic. So
It's like
yeah,
we're just coming off of that the financial flash, right? When the Silicon Valley and those bank and the regional banks failed, it's like we've made that up, but we have so much more to go versus the last what? How far did you go back? 2 years, 3 years?
yeah, just to the beginning of the pandemic. So right here, January 2020 is when, March 2020 is when we started to really buy those bonds. And you guys got to remember that when the Fed buys these bonds behind the scene, the money they're using to buy these bonds is funny money. It's money that they created themselves. And so when they sell these bonds or they allow bonds to mature, they're actually shredding cash. So they're taking cash. They were putting cash into investors' pockets back in the beginning of the pandemic, and now they're trying to take that cash back out, right?
That's a very interesting dynamic to look at, right? And it's just like I guess the question would be how long is it going to take to go back to the 2020 levels, and will we ever get back to those levels? Are we just going to accept these new highs?
Overall, printing this type of cash in this way, it does weaken you on the world economy. I mean, if you take a look at it, we started really printing this cash after the original financial crisis back in 2008. We had been really minimal at doing that. And, you look back over time, and it's been those economies that had to print cash um, that soon came to some sort of conclusion, right? So you almost worry about this situation. You hear about news about kind of other countries in the world deciding that maybe the US currency isn't the best currency to do business in. There's a growing population of folks that are changing their focus off of the US dollar. So having this kind of funny money floating around really does weaken our case as being a global superpower.
Yeah, I'm very glad that we're able to bring this up and also educate the viewers because I don't really hear anybody talking about it in the mainstream media. So it's good to understand that these are some of the dynamics that move the market. Checking the notes real quick. Manufacturing, right?
Hmm.
That was something that came out a little bit lower than expected. Also, something that's not in your notes, but the Bank of England increased by
Hmm.
0.5, right? Or 50 basis points. And that seemed a little bit aggressive compared to us continuing to pause. So a lot of uncertainty still in the market. Yeah.
Yeah, with the Bank of England continuing to tighten, inflation in Europe, we are talking about some really strong numbers here in the United States as far as inflation goes, but we're in a silo. When you take a look at what's happening in Europe, the inflation, especially spurred on a lot about, the conflict that's in their backyard in the Ukraine and their energy concerns. Their inflation is almost double of what we expect here. But it's interesting because our Fed keeps talking about this 2% rate, and we've talked about it here on this show about how valid is that 2% number. I mean, that 2% number actually came from the New Zealand uh, central bank a couple decades ago, and we kind of latched onto it. So you almost wonder when we're striving for goals if every once in a while we should reevaluate, especially look at the history of where these goals come from. We glom on, like fixate on, hey, our economy should only be growing at a 2% rate, but who decided that back in the day? Who decided that 2% is the right number? It's an interesting
Yeah,
dilemma.
and that's almost even before the spur of technology, right? Like things change really, really fast nowadays.
Mhm.
Okay, PMI, yeah. PMI is
Yeah, so that was released this morning. And so PMI came in a number below 50 means we're moderating or even going into a little bit of a recession. So 53 is a nice number. It's just right over that edge of stagnation to growth. But manufacturing, you could see, has really dipped down. They were expecting it to be at 48.5. It's down at 46.3. So manufacturing is shrinking. Here's a heads up for those folks who have some money. Save your money, and I bet you in the fall, and especially on some of those late fall sales, I think this year is when you're going to be wanting to, if you missed all those sales that were happening during the pandemic, I think you're going to get a chance to get even better deals this fall for what you're doing. Services are still hot, but even different, not the PMI, but different reports on services are even showing that people are starting to save their money on services. We're even seeing people who usually will buy at stores like a Target or a Macy's or a J.C. Penney's or a Kohl's, starting to spend more money at places like a Walmart. So you're starting to see these tightening measures grab hold in the economy.
all right. And finally, before we move on into some of the other topics, the VIX, right? We do love options. The entire premise of the show is how to use options to invest, to trade. And the VIX is continuing to lull down there at those lows, it looks like.
Yeah. Let me recalibrate here our moving average, or our best fit trend line. Yesterday we had the lowest VIX reading that we've seen in a while, down to 12.73. I mean, we haven't seen a number like that. Let me just go back in time here a little bit. Let's go back 2 years. I'm using just my drawing tool. Not even in the last 2 years. Let's go back even further, Sip. Let's go back to 4 years. All right, so 4 years ago, we saw it all the way down to 11.42. This is a measure, like we've said in the past, this is a measure of how uncertain or how fearful investors are. And when this number gets this low, it's the opposite of fear. It means that investors are somewhat confident. And they're confident, as confident as they were before the pandemic started. So this is interesting because you usually see investors' confidence at a low, or their confidence is at an all-time high, which makes the VIX at a low. You usually see that under presidential movements that are more business oriented. And so to see this number be this low under this current administration here in the States is quite surprising.
And as a options trader, and utilizing options investments, how do you use this VIX low information to help you make decisions or to help you validate, certain positions?
Well, so now options can actually, there is a component of the option price, especially at the money options, that is affected by what traders believe, right? Because when traders perceive that there's something volatile coming up in the future, and they become a little bit fearful about what their investments will do, they'll purchase these options as hedges because options lock in buying and selling prices. So they create a little bit of control when unexpected tides are on the horizon, if that makes sense. And so what we're seeing is that investors are not using these options as hedges, which means if there's no demand for these options as hedges, the price of them falls. And this is, again, especially true for at the money near term, at the money 3 month out, something in those ranges options. And that's what we're seeing. And so we need to know that. We need to know that if we're trying to trade based on volatility swings, that they're not really going to be there right now. But the patterns we are seeing is that if you're still trading theta decay, that value, that component of an option price at expiration by definition is zero. So no matter what you sell the option for, when you do sell it, it's going to go to zero. So you've still got money to be made on profiting on time passing by. This just tells you that there's some opportunities. Some of the opportunities on volatility trading isn't there. But at the same time, I know plenty of investors who believe in something called mean reversion. And what that means is when the VIX gets this low, that it's sure to start to pop up again. And so I know a lot of investors who are watching these VIX numbers and also watching the implied volatility on individual stocks and ETFs, and they're looking for a bottom to be found, and they're going to, trade that VIX as it reverts back to its mean. So there's opportunities all over the place if you analyze and can see the pattern that, identify the pattern that's present.
And for your main strategy, the premium selling, ideally, we would want the VIX to increase a little bit, right? We would want the activity of people purchasing those quote unquote insurance contracts to go up because the price goes up. Therefore, the premium goes up and you earn a bigger paycheck, essentially, right?
Yeah, it's a double-edged sword. So what you say is absolutely correct. So we love it when there's a little bit more uncertainty in the market because our paychecks are bigger. However, what does that perceived uncertainty usually mean? It's usually not unfounded. So when people perceive that uncertainty and they're buying risk, it does mean that the patterns become more and more unpredictable for us. And so even though we get higher premiums, it's at a cost of maybe what we're seeing is not really what's going to happen in the next few days. It comes at a cost of maybe our positions going against us. And so it doesn't hurt to have this low volatility. It makes more consistent trades that potentially just have less profit. So longer trades, but perhaps trades that don't pay as much. So there's always a balance in the markets. You never get something for nothing.
Yeah, and that's exactly the point behind the show is looking at examples, finding opportunities where we can apply these premium selling approaches and a slew of other strategies that AJ reviews through the week. And so once again, the show is live. So if you have a question or if you have a ticker that you want us to run through, feel free to drop it in the chat. If you want to learn more about the premium selling strategy, utilizing options in this concept of generating income like a paycheck every month, then head on over to AJ's free daily workshop where he breaks it all down. And so we've just thrown the link to that in the chat. We've got our trending topic or a topic to discuss. We've got AJ's pick of the week, and we've got our speed round later in the show. As always, we're trying to educate the world on options trading trainer. AJ and the team have been doing this for over 20 years. And so we encourage you to get involved, to ask questions, to bring us in and maybe teach us or show us a few opportunities that you're seeing, because we love seeing new names and new opportunities. So we're going to take a little bit of a break. We'll be back to go into our trending topic, and then we'll go into some live options examples to see if we can find some winning opportunities. We'll be right back, folks.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. I love seeing that video, because I think that's one that we did in the summer, and it just reminds me of cruising around the city, looking at the sunshine, not worrying about investing, not having the screen up, not having the computer up, looking at all the positions, what's going on in the market, because your approach is very different than that. And it kind of brings us to our trending topic for the week, our question of the week. And that is this perception of active trading and investing versus passive trading and investing. And so, one, which one are you, or which one would you consider? And 2, what is the better approach? And is one better than the other?
Well, I mean, so active investing and passive investing, by definition, passive investing means you put your money somewhere and it grows and you don't have to do anything. And so passive investing might be investing in mutual funds, definitely bonds, certificate of deposits, different things like that, where the risk is almost nil and you're guaranteed some minimal amount of growth. What else? Perhaps money markets. Those are all examples of passive investing. Active investing is where you have to increase your knowledge about what's going on. You have to increase your activity. You're actually kind of controlling your own destiny. And you could hire people to be active investors on your behalf, or you can, take that on yourself. And then I would say that there's different degrees of active investing, Sip. There's some degrees where it's, and it depends on what investment vehicles you decide to choose, but some active investing is more active and has a higher potential for gains, but you have to be even more involved with your computer, and then or with your trading platform. And then there's less active. And for me, the answer is not just what type of returns you can get, but what type of returns you can get as a function of the effort you must put in. So I like to think of it as almost being an efficient trader, right? Efficiency is always a definition of how much you have to put in to get a certain amount out. And so you can see what is the most efficient, because I actually value my time. Like you were saying, I would rather be walking on the beach or doing some of my passions. I've got a couple of passions that are career oriented. I've got a couple of personal passions. For the most part, since 2005, I retired from the workforce. So last thing I wanted to do was create another job. And so one thing that's really important is if somebody wants to enter into this realm of active investing, that they look at these different aspects and not just at the potential rewards. Because sometimes when you look at the potential rewards and you pick up a type of investing that you've decided, I'm going to learn, I'm going to master, when it comes down to it and you have learned it and you're starting to do it, you realize, boy, the amount of effort I have to put into this doesn't allow me to have a life. Day traders are known for this. Day traders are known for burning out after 6 months to a year. Just like the old floor traders, people who could last more than a couple of years as a floor trader were far and few between. Same with day traders. So I always hear newbies come to me and say, do you teach day trading? I mean, not really, because day trading, I really want to see you doing this. For me, it's a marathon, not a race.
I think the marathon race analogy is spot on, especially in a day and age now where there's so many different things to invest in, right? And it's easier than ever given the mobile components, the speed, and so I guess my follow-up question would be, do options make it easier for you to be a little bit hands off, a little bit more risk reward? I'm gonna bet 20 to try and make 27, but I can only lose 3%. Like this type of approach where, hey, I'm gonna make 3% and I'm okay with that because next week I can make 3%. The week after that I can make 3%. I might lose 1%, but one can sleep at night easier knowing that there's a reward and there's a risk.
Well, options are they've got a complexity to them. They're not as simple as people make them out to be. And they do get a little bit of a bad rap because in one way that we use them, in a leveraged way, they can be quite risky because you are leveraging. In other words, if a stock goes up $1, the option is positioned to go up quite a large amount based on the stock going up just a little amount. But what people don't think about is this opposite is true. If you use that same leverage component and the stock goes down a little bit, your option could quickly wipe you out. So people perceive options as these very risky instruments, but that's one out of many ways that they can be used. I mean, the way that big money, the folks that actually have big enough purses that they can move the markets, the way that they use options is to hedge against risk. And so what they like to do is they like to use options because options allow you to lock in buying and selling prices. And so they'll use options not as leverage instruments, but as ways to lock in buying and selling prices to remove risk. So for instance, if something is going to start dropping in value, you want to lock in a selling price so that it automatically sells. And an option will allow us that ability without fail versus, say, for instance, a limit sell order, which may or may not fill depending on how fast the price is dropping, right? The options are a passive way to really control risk. And that's how I teach my folks to use them. We use them as strictly risk stopping, risk minimizing vehicles rather than really cranking up on the leverage component of them. And so, yeah, options I think are fantastic. What I sometimes get confused with is people who come to me and say, can you compare and contrast, for instance, buying gold and silver versus investing with options? And it's like, well, I don't know. Can you compare and contrast an apricot with a watermelon? One of them is buying a precious metal and holding it. And another one is doing active investing versus, usually buying a precious metal is more of like passive investing. And, with an option, it's a whole different focus. And it's not only an active investment that you're participating in, but it's, I almost feel like those questions are coming from a very narrow focused idea about risk, right? Or about reward, like which one can I make more money on? But again, you're missing the whole point of the discussion, which is effort. How much effort do I have to put in to trade each one? what's the risk picture of trading each one? Those are more nuanced topics than can you just compare and contrast investing in gold versus selling options.
I think what a lot of people get scared with, at least new investors or investors that have never used options, is the word leverage, because leverage can be scary. But if you understand it and you know how to use it, it is to your benefit, right? And we go over a lot of examples where if you were to buy the stock outright, it would be something like you would need 20 grand in your account to do so. But if you wanted to take the same position using an option, you would only need a fraction of that capital. And that's one of the great assets of using options and understanding that. So thank you for the active versus passive. I'm wondering if people are curious on a day-to-day basis, how often do you actually look at the markets? What's your routine look like?
I love that question. Yeah, I look at the markets every evening, but I don't spend much time. I mean, I look at it as a routine or ritual that I've gotten into. Just like many of you have a routine or a ritual where every evening before bed you brush your teeth. Well, every evening after the market has closed, I take a few minutes and I see what's going on. Now, I don't do that by watching the talking heads. Like I had a friend who said, well, I do the same thing. I'll watch Jim Cramer every evening for a half an hour. Okay. But what I like to do is I actually have a very structured plan where the first thing I do is I look at the big three indexes and the VIX, and I get an idea of what happened during the day by actually looking at the price action of the broad market. And then after I've done that, I have a list of positions that I have cash trades in. And I also have a list of positions that I've got paper trades in. And I'll go through each one of those tickers. Won't take me any more than about 20 to 30 seconds. I'll pull it up in the charts and see if any of them have triggered some of my trade plan steps. And if there's no trigger, I just move on. And so out of, say, for instance, 20 to 30 symbols that I look at in an evening, if you think about 30 symbols and me spending about 30 seconds on each symbols, that's 15 minutes. So I spend about 15 minutes looking at, these symbols, and out of 30 symbols, I may get, on a busy night, 2 or 3 of them that trigger steps. And the other 27 of them, I just pass and come back the next night and see, if there's any signals that have been triggered at that point. And of the 3 that do trigger signals, I'll spend a little bit extra time looking and seeing if those signals are valid signals, or if there's signals that don't have volume validation, don't have price action validation. If they do have validation, I'll set up my automatic trader for the next trading day, and I'm done. I'm out of there. And that's what I do every evening. I go through the same rituals, same routine every time the market closes. I get an idea of what it did. I look at my specific focuses. If any of those focuses trigger my trade plans, I see if those triggers are valid or not. And if they are valid, I'll set up my automatic trader for the next day, and I'm done.
And that's the secret formula, folks. That and knowing what to buy, where to buy it, when to sell it. And that,
the whole trade planning.
Yeah, and that's why we've got the webinar. So if you want to know the ritual, the strategies, head on over there, check that out. And then on Thursdays, you and the trading trainer community come together and you throw ideas out. You're throwing ideas out. The community's throwing ideas out. You're looking at positions, and that's part of the value of being in the trading trainer community. And then on Friday, we come around on the show, and we're so lucky to have all that week of knowledge and education and analysis to provide our lovely audience with a pick of the week. So let's head right on into a live example of using options and premium selling and legging into positions to see what opportunity we can create for ourselves this week. And so, AJ, your pick of the week is a very well-known name, I think, to the viewers, and that is Verizon, ticker symbol VZ. What's the play?
Well, so we just got through talking about leverage, and where to use it, where not to use it. And Verizon is a perfect example of where I'd like to use just a modicum of leverage. So Verizon is forming a bottom support that we have seen before. And this is a perfect time to be buying some Verizon stock if you can afford it, or we can incorporate a tiny amount of leverage. So in order to stabilize the price, first of all, the type of an option I want to buy to take advantage of Verizon going up in price would be a call option. But it doesn't end there. A lot of folks believe that every call option behaves the same way, and that's absolutely not true. In fact, we have a once a month lecture series that my program participants have access to, and it just happened this past Tuesday, and we talked a lot about the different components of the option price this past Tuesday. And so they learned hands-on how an option that's at the money and near term will behave completely different than a call option that's far out in time, deep in the money. And to get the effect that we want to get, we want to go far out in time, deep in the money. And I was looking at these options right before we got on this call, and I'm thinking, I want to go all the way out to June of 2024. I'm talking about an option that's going to expire about a year from now. That's the option expiration date that I'm interested in using. And I want to go fairly deep in the money. And I was looking at this very popular $25 strike price. The calls are, of course, are over on this side of my table right here. You can see the name call. That's versus over here where we've got this puts. So I'm looking at these calls. I'm looking at the 25 strike price. It's not nearly as deep as I usually like to go, but it does have this liquidity that I'm looking at, the open interest. It's got a pretty nice small bid-ask spread of just a couple 10 cents, a dime. And so I really like this particular option. And look, the stock is trading at about 36 bucks right now. This option is trading at about $10.95. And so I can use this particular option. It's about a little under a third of the price of the stock. And it's going to behave just like the stock in our example. And it'll set us up beautifully, SIP, in the next couple of weeks to be able to sell call premium when we're at a high and buy protective puts at the same time. So it sets us up beautifully for doing those type of trades that we like to do. And should it not top out like we think it will, like it has over and over, should it continue more in an uptrend, which is always possible, then we'll just ride that call option to some pretty hefty gains. So no matter which way it goes, we're pretty happy with this particular trade. And this is all in a low volatility scenario, isn't it?
It is. And real quick, what is our potential reward versus risk? And how long would you expect to maybe hold this position?
Well, you can't ever foresee how long it'll take for the trend to go. We can look at history and we can see that trends usually take about a half a month. And so maybe about 2 or 3 weeks. And if we start to detect that a top is found, that's when we'll set up those income trades that I've been talking about. And here at Trading Trainer, we do very unique income trades. We don't just sell premium. That's our first line of income. But we also like to, at the same time we sell premium, buy ourselves a protective option. And by using that specific timing, rather than putting the protective option on when we don't really need it, but instead putting the protective option on at the same time that we sell premium, we set ourselves up not only by protecting or collaring our position, but by creating a second source of income, because a lot of times we can sell that protective option back when it's no longer needed for a profit. So it creates two sources of profit. Coming back to your question, we could profit off this in as little as a half a month, or we could start creating one of these trades that I love that gives us an income about every expiration date, so about once a month. And that thing could last Well, I mean, I'm setting up an option that expires a whole year from now. So that thing could last for a whole year where it's just paying us double-digit returns like clockwork every month.
Or if you were to buy the stock outright and the stock continued to increase through the rest of the year, essentially every time it increases, it's just adding on to your total minus whatever you had as the protection, right?
That's correct.
All right. That's options premium. That's premium selling. That's using options.
I'm liking Verizon right now.
All-
I'm liking Verizon. I'm liking a leveraged position against Verizon.
And Verizon is a company that doesn't seem like they're going to be going out of business anytime soon. Lots of customers, lots of sales. They're almost too big to really be dramatic at this point, but you never know with the telecoms.
I noticed that they're doing a pretty aggressive play against T-Mobile, right? T-Mobile just merged over the last few years with Sprint, so they're big players these days. But Verizon is going after T-Mobile at a time when T-Mobile, who's finally merging the two networks together, the Sprint, and therefore that means, when you're doing that type of merging, they're laying off a lot of folks. They're trying to I noticed that a lot of their benefits that they've been offering customers are starting to dry up. So right when T-Mobile is in this phase of pulling things away from customers, Verizon has come on the full attack. So I'm pretty excited about trades on Verizon, especially these trades that we do where we can profit whether it goes sideways or if it decides to continue going up, we'll win in that case too. And you're right. Verizon gives a nice healthy dividend. They have a nice healthy dividend coming up that they make money every earnings. They're kind of a boring stock these days. Perfect for what we're interested in.
Yep, I was just gonna say that, just boring enough to have a little bit of action. And so once again, that's AJ's pick of the week, Verizon. Now we'll head into our speed round, and so these are a few tickers that some of our viewers have brought up. AJ really doesn't have an opinion. We kind of pull them up on the fly to see if there's an opportunity to get in. So let's dig right into the first one. This is Emily from Sacramento, California, interested in your take on Riot Platforms, ticker symbol RIOT. Wondering if this is an AI play.
Maybe we could look that up. You're going to look it up while I'm talking about the technicals?
I'll look it up.
Okay. Platform. All right. So Riot, trading at a nice price, Emily, but let me go back because I see that I've got some drawings from history. So it means I've looked at this before. It's not one, I'll tell you this, it's not one that's actively on my radar right now. Okay, I see that I was looking at it back in the beginning of 2022. It sort of lost its luster for me. I'm looking at these earnings, and I just noticed this most recent earnings, it actually made money. It had lost money on every earnings over the last 2 years. Actually, it looks back here, it looks like it did. This was in August of 2021. It made some money, but other than that, it's been losing pretty consistently, and now it's made some money. So that's a good sign for the company. Coming on back here, I don't know, Emily. Unless you've got some sort of good feeling or confidence about Riot, let's look at the option chain. All right, so if I look at some options that I would okay, they're trading every dollar. They actually have a very healthy options chain. So now I'm getting a little bit more excited because when I've got an unhealthy options chain, then I'm ready to just bury it. Here's the scoop. This is how I think I would trade Riot. If you like this particular stock, I think I would sell some cash secured puts. In other words, I would pick a price, and I'm thinking maybe the $9 price. And I'm picking the $9 price because that would be a real steal for this particular stock right now. So let's say that we'd be willing to pay $9 a share. So what you do is you go and you make sure you have that $9 per share, and you remember that options are sold in lots of 100. So you really need $900 for every contract you sell. But when you sell a contract, you're going to walk away with $1.82 or $182. So you put that $900 to one side, saying, I'm willing to pay $900 to get 100 shares of stocks, or multiples of this $900. But then you just start selling these $9 puts. And this one, actually, that's the December 2023. Let's come to the one that's going to be available just on July 21st. So let's go to that $9 again. So, okay, $26.50. Still a pretty nice return. So if I'm socking away $900, but every month I'm making something like $26.50 on it, I'm making 3% a month. And so every month that I don't get that awesome buy price of $9, I make 3% on that $900 that I'm setting to one side. A lot of people are lucky if they make 3% a year on their money, and you're making 3% every month. And then what's the worst thing that can happen? The worst thing that can happen is that somebody finally agrees to sell you this stock at the bargain basement price of $9. Once you own that stock, you switch your tactics and you start selling calls against that stock. Again, keeping that monthly 3% or more coming in. I think that's the best strategy for here is let's sell some cash secured puts at this bargain basement price. Make the 3, 4, 5% every month on selling those cash secured puts. Once the cash secured put goes through and we accumulate some of the stock, let's keep that monthly income generating trade going through by now using covered calls to continue the income train. I like this. I think that's the way I'd go on this.
Yeah, not seeing anything on the AI side. Might be spurred a little bit by the recent Bitcoin rally. At least
is Riot Platforms in the crypto space?
You know what? I'm not really sure what they do from my research, but AI is not popping up for them. However, it is a nice price stock with liquidity on the option side. So yeah, AJ, I think your analysis is spot on. So thank you very much for bringing that to our attention, Emily.
Thanks, Emily.
Moving on to a next name that's been in the news, I feel like, all week. And this is Jacob from Orlando, Florida, interested in NIO, ticker symbol NIO, the Tesla rival. Yeah.
Yeah. Well, NIO is, they've been making electric cars. They're the Chinese company that has been making electric cars on a budget. So, their cars, I think, are going for $15,000, $20,000, $25,000 instead of the Tesla price of, around $60,000, $55,000, $60,000. But their cars are only available in China. There might be some other economies. They're not really sold here in the States. That doesn't mean, China's got a lot of people. India's got a lot of people. Let's take a look. So NIO is one of these companies that is traded on our exchanges, but at the same time, investors know that this is a Chinese-based company. There's a lot of rhetoric about China, taking trade secrets, China being an authoritarian government. And so investors have been a little bit afraid, no matter how good the company is doing, no matter what greatness these products, no matter how well the business model is, offering electric cars to the middle class instead of only to the top levels of the environment. Investors kind of are hammering and have been hammering NIO since the pandemic started. Actually, I can see I was taking a good look at NIO and then I kind of lost interest in NIO. It looks like it's stagnating. So let's take a look here and see if there's anything we can do with NIO. You mentioned that NIO is in the news. Right there, that kind of scares me. I rather have a stock that's never in the news and it's one that investors are totally happy with than one that gets the attention of investors, whether it be negative or positive attention. I see that NIO, the company, isn't really making any money. So investors are just not happy with this particular company. They've at one point, I believe NIO was trading up in the 20s and 30s, and now it's down at $7, $8, $9. I don't even see that NIO's got a pattern that I'd be interested in. I think the company's not going anywhere. So I don't think it's a bad thing to invest in NIO, but I almost feel like maybe there's some lower hanging fruit for us out there. What I might consider is NIO looks like it just recently, like over the last 4 or 5 days, formed a top. And so what I might consider doing is shorting some NIO at this point. That means either selling short the stock, meaning you're going to sell to open, and then the idea is to buy back to close at a lower price. The other thing you could do instead of shorting NIO is you could buy some put options. Remember, all put options are not the same. We want to buy put options that are going to be one-dimensional. They're going to go inversely with the price of the stock. So again, I think I'd focus on these June 2024 options. I'm going a year out, and I'm going to go pretty deep in the money. Maybe I'm going to go with, just looking to see the open interest. Maybe I'm going to go with this 1750 strike price. I could also see, for instance, I like the 1750 strike price. So this is pretty deep in the money. It's also far out in time. These things, interestingly enough, they're going at about the same price that NIO is trading right now. No leverage. There's no benefit of buying this put option versus shorting the stock. Besides, it's a cash trade. And I don't know if many of our followers, SIP, understand the difference, but buying a put is a cash transaction versus shorting the stock, which requires a margin account. So if you don't have a margin account, you can get the same effect of shorting this stock by simply buying this put. It's about the same price. And you can do this even probably in a retirement account. Most retirement accounts allow you to buy put options. So I would buy this put option and see how far NIO drops in price. Once it drops and starts to bottom out, you could either get rid of that put option at a profit, or you could start selling put premium and turn it into an income trade. Lots of opportunities in that way, but I don't think I'd be wanting to trade NIO in the long term. It wouldn't be something I'd want to have in my portfolio for the long term.
All right. There you go, Jacob. That's AJ's take on NIO. Moving on to our third and final name of the speed round. This is Benjamin from Tucson, Arizona, interested in gas oil company Chevron, ticker symbol CVX.
You know, oil is down. Oil is what? It's about 60 something dollars, $69 a barrel these days.
Doesn't feel like it in California, I'll tell you that.
Yeah, California's got a lot of taxes on their fuel. Well, it looks like Chevron. Well, first of all, Chevron's expensive. So depending on the amount of risk you take on, and the amount of risk you take on is proportional to the price of the underlying stock. So this thing is trading right now at about 150. It looks like it likes to trade up to 60, 65, 165. So, I foresee that you're going to need to have a pretty large portfolio to maintain the risk. So let me make sure I caution everybody out there. Make sure you understand how much risk you're taking on, and make sure you can afford that risk. When I say risk is another word for max loss. So analyze and determine what your worst case scenario of your trade is going to be. Make sure you hard code that in. So use stop loss orders, use protective options, something that's going to hard code that risk, that worst case scenario in, so it doesn't get any worse than that. And then once you have quantified, like, hey, I could lose this amount of money, make sure that's an amount of money that you're willing to lose, right? Because a lot of people don't go through that thought process. Whether they fall short of, I've had people say, well, I'm going to set up a risk stop at losing no more than 10% of the trade. Great. I'll come back later towards them and I'll see that the trade is down 20%. And I'm like, you got out at 10%. And they'll say, no. I'm like, but I thought you said you were going to hard code the risk at a 10% loss. They're like, yeah, but I didn't actually hard code it. And the price swung past that point and I didn't react fast enough. And now I feel like I'm in the game for the long term. And I'm thinking to myself, what? How did that happen? How is it that you didn't do what you said you were going to do? The whole idea behind planning a trade is we plan our trade and then we trade our plan. And obviously you didn't trade your plan. So with that said, keep that in mind. Make sure you can afford the amount of loss that you potentially will incur by trading Chevron. Now, assuming your portfolio is huge, I would look for a bottom here. So it looks like we're testing a level of support around $150. Look for this thing to reverse up. And if it does reverse up, that's a perfect opportunity to buy ourselves either some shares of stock. Make sure you buy them in lots of 100, or just like the name of this game this theme, we can use some leverage. So maybe a particular option I might be interested in would be this June 100 or this June 110 call. I'm talking June of 2024, not June of 2023. So this June 110 call, it's trading at $41. I'm sorry, $44. It's trading approximately at $45 a share versus the stock that's trading at $150. So for about a third of the price, we could get similar movement in this option that we would get in the stock. And that would set me up for selling call premium in the future. So I like that particular trade, but again, only if I can afford the loss.
All right. Yeah, a little bit more on the expensive side, but thank you, Benjamin, for bringing that up to our attention. That wraps up our speed round, and we're getting very close to the end of the show here. So once again, want to invite everybody to the webinar that we talked about earlier in the show. The link is in the chat. Also, if you're looking for a little one-on-one help, AJ and the Trading Trainer staff have a wonderful one-on-one coaching program where you can have a little bit more guidance, a little bit more hand-holding, a little bit more mentorship. Some people like that approach, and so we went ahead and threw the link to that in the chat as well. So if you want to learn more about AJ's one-on-one program, the link is there. Seeing a lot of good growth, a lot of demand, a lot of new students coming in there. So that's great to see. Heading into, would this be our first summer weekend of the year, right? Technically, June 22nd is the summer. It's the 23rd, heading into the end of June. What should we be looking at? How should we be thinking? What's on the horizon?
I think there's a lot of ticker SIP that we can consider trading some premium against, whether we've already got the holding in our portfolio or we're setting up those type of trades. The summer doldrums are typically a time when stocks go sideways. That's the premium traders like cup of tea. So I think just doing an overall assessment of our portfolio and then an overall assessment of our watch list is what we should be doing this weekend as we, like you said, enter into the summer season.
And if anybody's interested in joining the Trading Trainer community, jump in that webinar, jump in the one-on-one session, head on over to the website, create a login, and someone, or you'll probably get an email giving you some instructions on how to become part of the community. So always looking for new interested people that love investing, that want to learn more, that want to contribute, that want to help each other grow. So the links are in there. Once again, AJ, thank you for your time. Everyone else, thank you for joining us today for our lovely episode 86. that's all we got. Any final words to head into the weekend?
No, I think everybody please have a great weekend.
That's right. Everyone go enjoy your family, enjoy your loved ones, and tell your mother, your grandmother, your sister, your auntie, your uncle, your nephew to tune in next week to the AJ Brown Show, where we'll be broadcasting live, telling the wonderful world about the lovely tool that we admire so much called Options. All right, AJ. Thank you, everyone. We'll catch you guys next week.
Signing off.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.